Hello and welcome to this live panel discussion today, brought to you by Business Leader in association with BOOST&Co. The aim of today's panel discussion is to give our viewers an overview of business sentiment going forward, assessing the likely challenges they will face and delve into how they can mitigate these challenges, in part by using funding and the capital that is available for businesses currently. To do this, we will be referencing a key report that was published recently by BOOST&Co. It is called the Geared for Growth Report, and it researched the views and attitudes of a nationally representative sample of around 500 business decision makers. We will send the report out to everybody who is viewing today, and it is definitely worth a read because the data reveals some real good insight into UK businesses and some of the barriers they're facing as they look to grow in the context of all the challenges that we've had. To do this, we've brought together a panel of business leaders and advisors. They are Joanna Scott, Managing Director of BOOST&Co. Welcome, Joanna.
Morning.
We have Adam Barron, Director of Growth Advisory at BDO. We have Bridget Hallahain, who is a Portfolio Director at Guinness Ventures. Hi, Bridget. We have Stephen Harper, who's the chairman of Ativo Group. They are independent financial planners. We have Russell Jarvis, who is the partner of Shakespeare.
Morning, everyone.
A law firm, and Ian Selby, who's the CEO of the listed cybersecurity business Phalanx Group. So welcome you all. What I'd like to do is start by bringing in Joanna. Joanna, obviously BOOST&Co have commissioned this report, and it is really, really interesting, and it gives a kind of, it essentially takes the pulse of kind of business and what they're feeling at the moment. Can you just give a quick summary of the exec findings and why you kind of wanted to commission the report?
Of course. Morning, everyone. Thank you to the panel, firstly, for joining us, and to Ollie for chairing. I'm Joanna Scott, Managing Director of BOOST&Co. Very quickly, Boost is a direct lender to UK SMEs. We're not a bank, but a private business dedicated to deploying institutional funds into the UK market. We've been lending since around 2015 and are soon to be deploying our fifth fund, which will provide term loans of between 1 and 10 million to UK SMEs. So we feel we commissioned this report a couple of months ago. Large businesses are often surveyed at key moments in time, but not so much SMEs. SMEs received a lot of support during the pandemic, and as a provider of growth capital to them, we were keen to find out how were SME leaders feeling about their prospects coming out of COVID. We suspected there was a lot of ambition, but perhaps a lack of awareness around different avenues of funding to support the growth ambitions that people might have, particularly surrounding non-bank debt. And we also suspected that there were probably some regional differences between businesses and what their ambitions were and how they might fund those. So as you say, Ollie, some really quick highlights of the report, which we'll make available to anybody who'd like to see it following the event. I think while we suspected there was ambition, a surprising nearly 80% of businesses, this was SME business leaders, so sort of CFO, CEO type positions, were confident at the prospect of achieving growth during the next year. Which is a high percentage, nearly 80%. The key focus for business leaders continued to be around recovering from the pandemic, especially actually leaders of businesses based more in the north of the country. And they saw that the ongoing effects of the pandemic as the key barrier to growth over the next 12 months or so. Investing in technology and research and development was the biggest focus for most SME leaders over 2022. However, there was a clear kind of lack of awareness amongst some businesses as to what type of funding help would be available to support that. So 70% of firms intended to access support to grow their business in the next 12 months, but nearly 17% reported that they weren't completely aware the funding sources that might be available to them. There was a clear feeling that if perhaps you had approached your bank to discuss debt funding and they'd said, no, thank you, that was the end of the discussion and that it was unlikely another lender might want to lend to your business. 44% of businesses believe that there was potential hidden costs of seeking debt funding and that might be a barrier to them accessing finance, which we found surprising. And then, as I mentioned, some regional and gender differences as well. So perceptions around debt for growth funding being more available to businesses that were in the tech sector, based in London, male-led. There was some clear indicators there. The final stat, which I thought was interesting, was that around 15% of business leaders believed that the UK hadn't actually been so good at providing growth capital for them over the last couple of years, even during all of that support that was made available during COVID.
No, thanks. Thanks, Joanna. And what we'll do, we'll start with the positives, and then we'll go on to some of the other challenges later. You mentioned at the top of what you were saying there that generally businesses were very, very positive. 78% said that they're expecting to achieve growth in the next 12 months. So what I'd now like to do is just bring in the other panel members, just see if that's something they're seeing amongst their clients, considering that COVID is still lingering and the impact of that, and obviously inflationary pressures. So Adam, I'll start with you. Is that something that your kind of customers and network echo?
We're seeing a massive opportunity for companies because the world has, if we're being really honest, the world really has changed over the last, say, 24 months. More and more larger companies are kind of looking at it and saying, how do we adapt to this new world that we're living in, and what technology and what processes can we bring in to help us to adapt? So there is more need from these companies to kind of make all their processes more efficient, more streamlined, and they're looking at more tech solutions to be able to do that. We're living in a new world, and these companies need to be more agile. I think also from a consumer point of view, a lot of people have been on their computers a lot more, which means that they've got access to a lot more information. And all the companies, the D2C companies that are going to market, really need to make themselves stand out. And it isn't just a matter of how much marketing can you do. I think consumers are more aware, so more knowledge, more need for different technologies and things in the market. But that also leads to a couple of threats as well. So I think a lot of funders and equity providers are sitting there and worried about, well, what happens if there's another massive pivot in the market that has been the last 2 years? How do we cover ourselves from a risk point of view? So what we're seeing a lot at the moment is that a lot of companies that have previously had investors and funders come into them a really high risk appetite. That risk appetite's kind of been dampened a little bit just because a lot of these funders and equity providers have felt a bit of pain over the last 2 years, and we're seeing that kind of normalize a little bit.
No, thanks, Adam. Bridget, just want to bring in you now. Obviously, if somebody fills out a survey, I guess that they're always going to err on the side of optimism, aren't they? But sometimes the realities do get in the way of achieving that. What are you seeing amongst your network and the sort of companies that you invest in, Bridget?
So we're generalist investors, so it's really variable. Some have benefited from COVID, in particular the e-commerce businesses, but we feel that those businesses will actually now struggle a bit more, with inflation going up, with people having less disposable income, and it will be other sectors that sort of will come into their own and come out of sort of the post-COVID era. But it's so dependent on each company, and we're sort of advising companies to look at their product and how that fits to the market that's come about, and actually look at sort of cash flow and costs on a company by company basis.
Brilliant, thanks, Bridget and Stephen. Just like to welcome you. I like your backdrop, Stephen. Looks very good. So yeah, if you could just if you want to kind of feed into your views on this question, Stephen.
Well, look, over the last 2 years, which has been dominated by pandemic and lockdown, as a business, we've actually trebled in size. So our turnover for this year will be more than 3 times it was in 2020. So actually, wherever there's a challenge in the market, whenever there's a shift, there's a genuine opportunity to take advantage of that. And I think that even though there will always be challenges going on for businesses, the nice thing I feel for SMEs is, given being a bit smaller, like was mentioned earlier, they can be much more nimble and make much quicker decisions. And technology can really enable that these days. And what's really helped us is our grounding in technology and our efficient processes. So adapting to lockdowns and pandemic meant that we could really drive growth. But of course, we couldn't have done that without funding. And funding was a real driver for us to be able to take advantage of that. There is always challenges. There's always risk. Doing nothing has risk. Growth has massive risk. But it's about knowing your business, knowing your sector, and knowing the people that you work with, and being prepared to really challenge what you've done before and look to improve on that. So I think that even though there is some, if you like, some clouds on the horizon economically, actually there is always opportunity for businesses that are prepared to grow. Funding is a financial instrument to support that and develop it. Develop your business, and I think there's great reasons to be optimistic about what's going on in the UK, providing you've got the right people around you and the right systems and processes.
Brilliant, thanks, Stephen. It's good to hear that your business has trebled revenue in that way. And Russell, just want to come to you now. Obviously, you act for lots of businesses in your role. How are they seeing the market at the moment? Obviously, you know that'll be dependent on what sector they're in, but as a general view.
Yeah, the kind of sense I've got is that there's a lot of pent up demand. People are really keen to move forward and secure funding and expand and get back to where they were. I'm seeing a sort of almost a concomitant slowness in the speed of execution of transactions, which I find a little bit worrying. So things are dragging a little bit, which I think is really, really unfortunate. That may be to do with the fact that people are, particularly on the lending side, are a little bit more cautious about the way the economy is going. But as I say, generally speaking, across my portfolio of clients and relationships, people are really want to get going. Really want to get going now, and the speed and accessibility of funding is critical to that, and in some cases it's taking a lot longer to get there than we would like.
Brilliant, Russell. You just you briefly mentioned that there is a bit more caution and lag than you would like. Do you put that down to potentially that we may be heading into recession, or is it other factors?
I'm a big believer in not talking yourself into a recession, and I kind of think there's a little bit of that maybe going on at the moment. But there are undoubtedly some very strong sort of headwinds, or a tsunami, as someone described it the other day. But I still feel that there's a feeling that businesses they really want to get back in there, and they really want to move forward and never say never. So I think there are some concerns, but the balance is still optimistic.
Brilliant, thanks, Russell. Ian, just want to bring you. Russell mentioned businesses want to get out there and do things. How are you finding things, Ian?
We're a cybersecurity company, so we have some very strong macroeconomic drivers. I mean, it was clearly the growing threat perspective before COVID, and then with the move into a digitized world and organisations having vulnerabilities on multiple fronts. That drove things forward, and obviously in the going with the situation in the Ukraine, obviously there's more cyber attacks and state-led ones. So we are seeing a lot more interest by organisations in addressing their cyber security. So one of our challenges has been to really grow the sales and marketing and expand our go-to-market on this. We've done a lot of investment already on our technology platforms, just obviously for monitoring our client base and as well as for our own internal operations. So we refinanced essentially last year. Boost came on board as a venture debt provider. We are actually listed on the AIM market of the stock exchange as well. So we actually also did a disposal of a non-core division. So we have really fired up the balance sheet with cash to see what we see as a very growing market in cybersecurity. Having said that, we are selling into the UK economy by and large, so we aren't immune from the economic pressures and looming potential recessions. But we think we are certainly, as a mindset, we're on growth and expansion mode. And it's about we've got a good team in place and growing that team and getting market share. And I think it's the mindset of whenever there's change in an economy, it's also an opportunity for growth as as disruption creates new opportunity.
No, thanks, Ian. I just want to stick with you. We were going to talk a bit more detail about the potential for recession, but I think I agree with Russell. We don't want to talk ourselves into one. So I want to just reference the report again, and it mentioned that when people were raising funding, tech and talent were two of the kind of key issues. When you looked to raise Ian recently through Boost, were those two the key drivers for you?
Absolutely. Growing the business, expansion capital, expanding the sales and marketing and the technology platform, growing in service innovation, and potentially some M&A as well.
Oh, so you are quite inquisitive at the moment and looking to potentially grow
at the right point, yeah.
Okay, brilliant. And Adam, I just want to come back to you. You mentioned tech earlier when you spoke. Is that what you're seeing when companies are looking to kind of bring on funding, that it is tech and people that are driving that?
Yeah, so I mean, there's a number of things, and I don't think that's changed at all really over the last 2 years or so, but really it is people, talent, sales and marketing. So it depends on what you've already got in the business, and I know it's going to be everyone's answer, but every business is different. So maybe some people have been set up by people who are really tech and they've got a really good tech proposition, but they don't really know how to bring that to market, and they need funding to bring in those people to be able to do that. Or you kind of have a decent tech platform with people who really know how to sell it into the market, but they don't really have the tech ability to bring it to that place whereby the tech is good enough or sells itself enough to be able to replace incumbent systems that people already have. So it usually is either for talent or sales and marketing. I think that one of the really interesting things at the moment is that with so many interesting new tech products coming to market is the availability of those really high-end developers. I think that's kind of where the crunch point is at the moment. I can see Ian nodding his head there, so Lisa, it's not just me that's seeing it, but there with this, and I'm going to use a buzzword here, but with this deep tech coming to market, with people really wanting that more cutting-edge tech, there are fewer and fewer developers that are around to be able to do it because they're being soaked up by all those other companies that they're being demanded from. So it's a positive and not a negative, but a threat to companies that are looking for to really build out their tech.
No, thanks, Adam. That's interesting. Bridget, I know you mentioned that obviously Guinness Ventures is generous investment. We're going to try and get a specific out of you though. Tech seems to be one of the key drivers. Is that something you would agree with when companies are coming to you?
Yeah, I guess when you spend money on technology, you're creating value. So you're growing the valuation of the business, and that's why it's a key focus area. But I agree with Adam's point. It kind of depends where the business is in its life cycle. You know, it might have a product, but actually be missing a sales and marketing team. So yeah, it is company dependent, but yes, technology is a key focus to grow value.
Brilliant. And Stephen, I've seen you nodding there. Is there something you'd like to add to that thread?
Well, I think that in this day and age, everybody uses tech, and we've seen evolution in the most simple and straightforward ways. The thing with technology is the pace of change is only getting quicker and quicker, and you need to have the right people in the business to be able to lead that evolution and change in your company. If I was in charge of our technology, we literally wouldn't be anywhere. So, you know, as a business owner, founder, you know, I've got to admit, I need way brighter and better people in my company to be able to lead that. And sometimes we're a very acquisitive business. We've bought 15 businesses in the last 2 years, and we plan to buy 10, 12 this year and keep going because of the consolidation that's going on in the sector that I'm in. And the thing I see about the businesses we buy, they haven't invested in tech, they haven't embedded it in their culture and embedded it in their processes, and their relationship with their clients is still very paper driven, not technology driven. And look, you know, I remember 15 years ago when I made the decision we would go digital for all our filing, and people in my business resisted me, and it was such a small business then and such a small thing. But nowadays, the thought of paper files, people would think that's ridiculous. And the pace of change now is even quicker than it's ever been, and it's only going to get even quicker again. So if I was advising anybody looking at growing and developing, is those two things of the people and technology are critical drivers. Now, of course, every sector has its own requirements, and it's very different, but the concepts are still exactly the same. If you don't have the right people in your business to drive it forward, you will not be able to grow it. And I've always believed in employing people that are much brighter than me, much better educated than I am, and much more capable than I am. And I have absolutely no problem with that. And I would encourage anybody that's looking to grow their business, get the best people in, invest in them, and get the best tech you can for your business. And those two statements are very simple sentences, but they are very challenging things to do, because we are in fundamentally a zero unemployment environment. And of course, finding the right people is always a challenge. But I would encourage people to think that it's more than just money that people work for. And if you are trying to attract talent into your business, really work on what can make your company, your business, and that role really attractive. Because there is some fantastic talent in the UK. And I think flexibility of working from home, working hours, benefits, the chance to be trained and developed and motivated, and that environment to do that, and the place of work, all those things people look at these days over and above just the salary. And I think I would encourage any business owner that's thinking, well, any business owner that has a business, of course, to create the best place to work and really.
That's some really interesting points there, Stephen. I think what Russ was trying to bring you in, what you know, Stephen mentioned there was, you know, doesn't matter the sector, but they are universal, aren't they? Good people, good tech, and the pace of change is going to be really, really important, and businesses grasp that. Can you just, you're right to add to that thread, Russell, and give your thoughts?
Only my own space in the legal services space. Yeah, I mean, tech is a real issue, and we put in a new time recording and management system, which was a major piece of investment and exercise, and that was quite painful but very necessary. But in our space in particular, it is around the people. I mean, believe it or not, there's actually a shortage of solicitors, and actually getting the right kind of person. Stop nodding, Stephen. Getting the right kind of person is a real challenge, and I think in the services sector, there is inflation in the wage space in particular is a significant issue, and I think that's going to be reflected in the SME space as much as any other space really, and meeting those challenges is difficult. It's very difficult.
No, thanks, Russell. I just want to move on to our next question, which I found interesting, is that there was a perception from businesses that they actually often find it difficult to access the funding they needed. But then on the flip side, we hear that there's never been so much funding available. So I just want to tap into why that is. And Joanna, if you could give your thoughts on is that driven by geography? Why are some businesses not cutting through? And is it information? Yeah, if you could kind of give our viewers some insight there.
Yeah, of course, Ollie. I mean, I think obviously as a firm who's very involved in this market, we probably wouldn't have been particularly surprised by that finding. Obviously, it's important to note that the report focused on SME leaders. So I think what we often find is large businesses tend to have a bigger finance team, a very experienced FD, CEO, board of directors, who have spent many years in the market accessing equity capital, debt capital. They're very versed in who to speak to, who to go to, which lawyers to use, and how best to present their business. And that probably stems from the fact that perhaps 5, certainly 10 years ago, that there was less funding, certainly debt funding, available for some smaller businesses. So SMEs may have a sort of CEO founder who has some financial experience, but perhaps not a full-time CFO or such a seasoned team. So the conversations, I think, tend to go along the lines of, well, we'll speak to our bank perhaps about whether we're now at the right stage for some debt funding to grow. Depending on the bank, it's often a sort of, well, you're a little bit early stage, or we wouldn't tend to lend for that sort of purpose if it's M&A or things like that. And then the conversation stops. It's sort of, okay, well, we're not quite there yet, not ready for the debt. Let's perhaps pursue the equity route. I think there is more awareness amongst smaller businesses around private equity and VC investment and VCT and EIS funds, and people are a little bit more confident to have those sorts of conversations. I think that what we are seeing, which is great, is a growing debt advisory sector. So there's always been a nice active corporate finance market in the UK for large businesses and SMEs, helping business owners to raise equity. That hasn't been such the case in debt, but we're now seeing quite an active market there, which is great, often from corporate finance firms who've brought in a debt advisory team. And also, I think equity investors like Guinness, where Bridget works, are becoming more involved in at the right point in time, speaking to their portfolio companies about, well, perhaps now is a sensible time to bring some debt into the business, and that's positive too.
Oh, thanks, Joe. Russell, obviously Joanna mentioned there that smaller businesses tend to perceive equity as sometimes a better route. So do we need a dragon's den for debt, Russell?
I think the big change in the last sort of 10, 15 years really has been the scaling back of what we say the clearing bank's involvement in this kind of growth type space in a major way. And there has been this, including people like Boost, that have come in to fill this kind of a gap. But there's and I think the debt advisory piece is very, very useful. And everybody, I'm sure Adam from BDO will agree with this. Everybody's got a debt advisory specialist now, or the major accounting firms, or even the smaller accounting firms have got that, and I think that helps. But knowledge of what's available is still pretty limited, even with those, because there are so many options available, and they all have their favourites. So yeah, maybe a Dragon's Den is a suggestion. But I think the thing is, it's almost beholden on the debt advisory people and the funders themselves to make themselves as well known as possible in the market, so that people have got the maximum access and availability to different sources of investment as possible.
No, that's a really good point, Russ. And Adam, do you want to bring you in here on that subject?
So we have a debt advisory team, but they do usually concentrate on slightly larger transactions, and us as our growth advisory team do concentrate on both debt and equity. And I think that is really helpful for our clients, because there is a lot of educating that needs to happen. A lot of the companies that we work with will still have a CFO that is more versed in traditional debt, and when you say, have you considered debt, their automatic reaction is, I don't want to have to think about debt. Debt's bad. But really, it's not. And that whole that whole phrase of debt is cheaper than equity, I think is going to come back a bit now with multiples. Has been revenue multiples and equity deals that have been quite well publicized completely falling from where they were in November. But I think there's a lot of education that needs to happen as to when debt is better than equity, but also when debt and equity can play together. And it's really good to hear Joanna talking about with Bridget, about how Bridget's looking at some of their portfolio companies and not just saying, oh, we need to do a Series B now because we're capped out of what we can do. Let's bring in a big Series B fund. It is, well, maybe the right option here for one of our portfolio companies is debt, because debt can bridge the gap to the next round, so that you're not taking dilution on your equity at a point that you shouldn't be. So I think that having an advisor that, and I'm not sitting here plugging myself, but having an advisor that can talk to you about the pros and cons of both debt and equity and the timings of them is really helpful, and especially when they can work together, because if we're talking about EIS and VCT funds, one of the pitfalls of using EIS or VCT funds is that those funds can't be used for cash out. So maybe bring in debt to be able to do that, or bring in debt alongside it to reduce the dilution that you're taking on, so it's not all equity, is another option. But really thinking about it more widely than just, do I go debt or do I go equity?
And thanks, though. It's a really interesting point, Bridget, isn't it? That sometimes businesses can think quite siloed. It's debt or equity, but there is that they can kind of combine. I just want to get your thoughts on that when companies are approaching you, and how you kind of have those conversations with them.
So at the point we invest, our companies are still loss making. So typically it doesn't make sense for them to bring in debt when we do initial investments. But later on in their sort of life cycle, when they're getting closer to profitability, debt does make more sense. I think, from my perspective, I always want to be comfortable that the companies can manage the interest and capital repayments, and they're not overstretching themselves. But I think our FDs and CFOs are actually pretty good and getting debt terms and knowing who to speak to. And we actually maintain a database of all the debt terms that we've received across the portfolio companies. So we're actually able to provide our companies quite a lot of support if this is something that they're interested in. But, we always want to understand sort of what does the cash flow look like in the future, and how will the business manage the repayment.
No, thanks, Bridget. Ian, is there anything you wanted to add to this thread?
I think debt is obviously an alternative we've used. The key is actually understanding the nature of the debt as well. Clearly, you've got to service and make the interest payments, but then making sure you absolutely understand and get into the minutiae of the documentation. So events of defaults, covenants, additional costs which can spiral, and there are some lenders out there who will leave tricky documentation out there, which can be set to almost trigger an increase in cost. So I think really understanding what is in the right, what is actually in the instrument. And what I found is, you look at the first set of terms you get from a lender, and if they're fairly written, it's actually it's a good sign. As opposed to others where if it's full of trip events or something like that, that's when it can put people off debt, and it sort of goes into your living memory about it.
No, it's really interesting, Ian. That taps into, I think, some of the findings from the report about the sort of hidden cost of debt and some providers maybe not being as open as they can be. I just want to quickly go around the room, as it were, our virtual room, and a lot of our viewers will be looking at this, and we've just spoken about some of the perceptions around funding, and they'll be thinking, what advice can you give me? I'm going to approach a funder. So just a really short bit of, from your vast knowledge, if you could just start, Joanna, and give a 10-20 second kind of elevator pitch to our viewers about how they should go about approaching a funder and what will give them the best chance of having a good deal.
Yeah, so I think there's three quick things, Ollie. I think start the conversation early. A good provider will be happy to chat to you a year, 6 months in advance, build a relationship, understand what they want, what you want. So start the conversation early. Possibly do use an advisor. It's really worth it, especially if you're a smaller business with perhaps a younger finance function. Using an advisor will really help you to meet more potential providers and get the most out of the process. And then I would say, crucially, do be realistic. Don't be over optimistic when sort of presenting your forecasts and things. There can maybe be some benefit to that in an equity conversation, but it's not in your interests or the lender's interests to over leverage a business. Nobody wants to do that. So let's have more of a realistic conversation about where you think you'll be in 2, 3, 5 years time, and then it should work really well for everyone.
Thanks, Joanna. Some good advice. Adam, if you can please as well.
Yeah, sure. So I think you just need to be really prepared. So you need to know how much you're looking to raise, why you're looking to raise the money. So what are you going to do with that funding, who you're going to go to. So Joanna's right, try and have those early conversations. I think that even using an advisor or not using an advisor, it's good to be on funders and investors' radar. Also, what are you looking for from a funder or an investor? Is it just the money? Do you need them to be a bit more value add? There are some investors and funds that are a bit more passive, and some that can help you either bring in a CTO or a CFO or introduce you to portfolio companies. I think that you need to have a look at your forecasts and kind of understand. I think this is where an advisor might be able to help you understand if your forecasts are going to give an equity investor the returns that they might be looking for. Or on the flip side, even if it isn't, do you need an equity investor, or does the face of your financial statements lean to be more of a debt raise rather than equity raise? There's quite a lot to think about, but I think really getting your house in order and understanding where your cash position, but your financial position and your forecast lend to is probably the most important part of the raise.
No, thanks, Adam. Some more good advice there. And Russell, if you could add to that, please.
I'm running out of options, aren't I? Everybody's giving the good advice ahead of me, really. I think the one thing I'd say is recognise that to get the optimal solution requires you putting in a goodly amount of time, and I think you have to recognise that it could be a longish process. I think the other thing I would say is that it's always a good idea to run a couple of horses at the same time, because some lenders can be a little bit capricious. They can take you almost all the way down the tracks and then suddenly pull out at the last minute. And if you've got no number two, then you are going to be in a difficult situation. So I'd say run a couple of horses.
That's interesting. Yeah, about kind of spreading your risk in that sense as well, Russell. So some good advice there, Stephen. Obviously, from your position of growing a business, slightly different angle. But any advice for our viewers?
Look, the best advice I can give anybody is get the best advice you can get. And what I mean by that is choose someone that's a specialist in the sector that you're in. There's so many finance brokers out there, but you don't want just any finance broker or any anybody that's going to support you with this. You need someone that's successful at raising capital and knows your sector. In my view, that's what's really worked for us. And I think the second thing I would say is make sure you know all your options, and don't just think the only option is debt or the only option is equity. It may be a complete combination of all of them, and you might actually and the point I'm trying to make actually is that raising capital is a key business strategy in its own right for growth. Give it the focus and attention it deserves. Don't just think you're going to phone up the bank or phone up Joanna and raise X amount of millions without prepping for it, knowing your business, and having a proper structure of how you're going to deploy that capital and what it means for your business. So best advice you can get, but relevant to your sector, with a track record of success of raising capital for a business similar to yours. And then you've got a higher probability of getting the result, and look at all your options. And
thanks.
One.
Thanks, Stephen. And Bridget and Ian, if we could, just briefly finish that thread with any additional advice. I know that all the points have probably been covered.
I just also reference, so if you're not familiar with the lending bank, I'd also make sure that you're thinking about how you present the business and presenting it in the best light possible, not something that's unrealistic, but for example, if you've got reoccurring revenue, make sure you're highlighting that. And the other thing is that I often find when a business has ambitions, often a bank will buy into those ambitions. So I think people wrongly assume kind of debt is going to be short term, but often a lot of the lenders want to be with the businesses throughout the journey and be lending the larger amounts when the business is bigger. So actually communicating those, I think, is really important.
Well, thanks, Bridget. And Ian, last but not least.
One thing is absolutely having a solid business plan and making sure you're sort of stress testing and asking the what if questions. And so you're de-risking it. So when obviously, you can talk to a bank, let's say there's a covenant involved, you've got a good chance of hitting it. You're not over leveraging or extending yourself. And then obviously, as Russell said, running a couple of horses as well. You can get to a final credit committee stage and you don't want to they'd be let down at the last moment, for instance. And then I think understanding the nature of the lender, what is going to be their sweet spots, what's their sectorial preference, what's their typical term sheet, how would what's the investment period, etc. Understanding what you're getting into, because you can have a far better conversation with a prospective lender. Things like where are they going to be in services business? How can they affect security, for instance, and making sure you're addressing those points fairly early on and getting that thought process ready.
Oh, brilliant! No, thanks, Ian, and everyone for that sage advice there. We were going to then talk about the hidden costs of debt, but I think we kind of covered that previously. So I want to move on to two very, very big topics. We only have around kind of 10 minutes to tackle those. So. But they're very, very important, and they were both kind of raised in the report. The first was diversity when it comes to kind of raising funding, and there is still disparities both with ethnicity and gender when raising money. Joanna, I just want to get your kind of thoughts on what the report found and what is being done to kind of tackle this.
Yeah, so Ollie, I think that what the report specifically found was an impression, certainly, that debt would be more readily available to businesses that were run by male leaders. I think around 27% of people, so quite a big number had that perception. I think that in what we find is that, as Bridget mentioned, debt becomes available to businesses at a point in time. So venture debt, some types of venture debt may be available very early as an almost sort of quasi equity sort of type investment, but more mainstream private term debt tends to be once businesses are reaching profitability or have broken through that. The reason I mention it is that I think that what we're still seeing in the debt space is a point in time issue. So I think that, to be honest, we don't see a lot of applications at Boost from businesses that are led by women. We'd love to see more, but we actually don't see many. There's probably a kind of handful, maybe up to 10 in our portfolio who have female CEOs, few more CFOs, which is good to see, because I think some industries like accounting, the legal profession, for example, have been very good at nurturing females in more senior roles earlier. So I know from speaking to people in the industry who are focused at businesses at an earlier stage that they are starting to see, more businesses led by females raise sort of seed equity, VC funding, because they're earlier established. So what we would like to see is more women in senior roles, CEOs, CFOs in more established businesses. And that probably means, they may not have founded them, but it means that businesses with male founders promoting females, to senior positions within those companies.
Thanks, John. That's really interesting, Adam, because I think that's more of a journey thing, isn't it? So we are seeing more female founders raising seed equity and venture capital, but on that journey, when you get to more sizable raises, potentially debt as well, we're seeing more applications from male, and as Joanna said, less females in those roles. Is that something you're seeing as well?
Yeah, completely. And I think that that kind of onus needs to be put on to the investors and funders to really show people from more diverse backgrounds, females or people from ethnic backgrounds, that the door is open. I think there's always been that historic mindset of it's an old boys club, and unless you're part of that club, you're not getting funded either by debt or equity. But I think more and more people are realizing that having a more diverse management team is better for a business, just because you have more opinions from different places, and having those kind of, obviously with everyone wanting the same from the business, but looking at the business from different viewpoints, which you will do, having different backgrounds, is only really going to benefit the business long term. So there's a lot of VCs that are doing a lot of good things. I know Guinness are involved on the earlier stage stuff, just doing events which are especially female focused, to say, look, our door is open. Please don't not go into starting a company or go into a venture-backed company because you think that by doing so, there at some point a door will be shut to you. The door is open, and that education just needs to continue, because I think it's only good for the UK SME market as a whole.
No, thanks, Adam. That's a really good point. Did anybody want to add anything to that thread before we moved on to the next question? No, that's fine. So our next point, and it was brought up in the report as well, and what we were going to conclude with is essentially looking forward. Obviously, we've seen at the top of the discussion that 78% of the people polled were very, very optimistic. We must remember these were an SME cohort. But obviously we've had, or during the report or since the report, we've had the conflict in Ukraine. So just wanted to get a sense of if that is making businesses kind of adjust their plans and hold back. So what we'll do, we'll start with Stephen, Ian, and then Russell. So Stephen, in your business, I mean, you've mentioned that you've had some really, really good growth. Are you worried about this conflict, and how are you kind of planning for it?
Obviously, as advisors that manage people's personal wealth, we're seeing volatility in investments, which impact portfolios. So, of course, as a business, we are directly dealing with that. But that's the thing that I've had throughout my career of 30 years. We've had so many events in those years, which even over the last decade, we could quote some. I think that some people, when they're looking at selling businesses, can perceive that maybe this is not the right time to do a deal because of concerns about the next year or so. But generally, actually it's business as usual. And you know, as a business, we're well versed of dealing with volatility in equity and investment markets. That's our day job. But from an actual business point of view and a growth in our business, which is predominantly based upon a consolidation through acquisition, actually it is business as usual. And if anything, if I was a business owner of a small business today concerned about the future of my business, I would probably do that deal today rather than wait for another year or so. So it adds a conversation, but the net impact is pretty much zero, if that makes sense.
Yeah, no, that does make sense. That's an interesting analysis, Stephen, and yeah, maybe there is an appetite to take action now, because if you are
some decision making. I mean, it's been a tough 2-3 years for smaller businesses that aren't technology driven. It's very hard recruiting, training, and developing. If you're a small 10, 20, 30 man business, that's tougher today than it was even 3 years ago. So sometimes an extra challenge, an extra threat of potential recession can actually almost be the final straw. So for us, if anything, it's probably driving that consolidation a bit more. Yeah.
No, thanks, Stephen. And Russell, if you want to, you know, amongst your clients and what you're seeing, are you seeing a bit more caution because of the conflict and potential recession?
Definitely, I'm finding that more sensitivities are being run about possible outcomes in the next 6 months, 12 months. I think that's the sensitivity analysis has been a lot more of that going on. I as I said earlier, I'm just seeing deals taking longer to get over the line. And I think that's because there is a sort of hesitancy. I don't know whether it's because people are hoping that things are going to get better, or they just want to, see how things are. So I'm seeing there is a lag. So all I would say is that, start those deals earlier, as Stephen was saying, get on with it now, because they'll get over the line quicker. And I think that the prospect going forward is that they're going to take longer rather than shorter. So if you're in the growth mode and you're thinking about opportunities, get on with it now.
Okay, no, thanks, Russell. And Ian, any thoughts on that thread?
We're a cybersecurity company, so as a result of the Ukraine and before, cyber attacks are up 50% year on year, and that's before real major state-on-state cyber warfare, which hasn't happened yet. We're seeing organisations are now having to take this a lot more seriously. Consequences of ransomware attacks or DDoS attacks can be devastating on an organisation. So we are, we expect it to be a growth driver across the sector in cybersecurity. So we are slightly different. Having said that, we still operate in the wider UK economy, and if there are recessionary issues across multiple sectors, then clearly we can't be immune. But we see there's a growth opportunity in cybersecurity at the moment.
Ian, this is a very naive question. It's just something someone said the other day, that surely if we were going to see more cyber attacks from Russia, they would have happened by now. Is that just a really naive thing to say? And can we expect? Some
will have been presented. And I was reading some articles yesterday saying that actually the real heavy duty stuff hasn't happened in either direction. I mean, there's a lot of organised crime attacks anywhere, ransomware attacks is happening, but the worst hasn't been inflicted.
Okay. Well, on that positive note, Ian. I just want to say thanks. That was just a sort of personal question. I just wondered there, but no, thank you for that, Ian. And I just want to say thanks to our panel. I just wanted to conclude with Joanna. Obviously, it was Joanna who headed up this report, and just some final thoughts from yourself, Joanna.
Yeah, thanks, Lee. I think to pick up on your sort of the forecasts and headwinds ahead point. I mean, I actually completely agree with Russell's point around not talking ourselves into a recession, which seems to the last couple of days increasingly be the case. But I think that there are a few growing headwinds now, domestically, internationally, that perhaps haven't been as short-lived as people were hoping, that are going to make things tougher. So I think equity valuations will start to come down, not maybe to particularly depressed levels, but not as bullish as they perhaps they were last year. I think that the banks will withdraw further from SME lending in particular, but obviously specific SME lenders and equity investors will be there to continue. And therefore, I think, and debt pricing, I think, people might be interested, will probably come up a bit. I don't think by as much as inflation. The bank seems to be holding base rates at still relatively low levels, but I think that people will probably need to be to pay a little bit more. But because that equity valuation piece, it still might debt will continue to be a good option. And therefore, I think that really tailoring a solution for your business is as important, if not more so, in this sort of environment. So, go with a lender or an equity provider who's really looking at your business, is providing a sort of bespoke solution, really taking the time to underwrite and understand the opportunities and the threats in your sector and in what you do. Is key and is sensible for you and them, and then should really lead to a good outcome. And then I echo again Russell and Stephen's point. I think get on with it at this point. It would be a good time now to get on with a funding solution or an M&A plan. While there's a bit of uncertainty, always breeds opportunity. So I would crack on.
No, thanks, Joanna. So I guess if we're going to punctuate this discussion, it would be to say, get on with it. I just want to say thanks to all of our viewers today. We will send you the report, and this recording will go live straight away on the Business Leader website. So we just want to say thank you to all of our guests today, and also to our viewers. And if you want to find out more about Business Leader events, do go to www.businessleader.co.uk, and also do check out our sponsors, Boost&Co, how they may be able to fund growth in your company. Thank you.